Understanding futures. In the past, futures were used as a way for a farmer or a producer to lock in a price for the future purchase of their products. Here is Wilbur, the corn farmer, making thousands of bushels of corn. Wilbur plans to sell to cattle farmers since they like to feed corn to their livestock. So he heads over to the cattle farmer, Tex, and says, "Hey there, Tex, let's agree now that you will pay me $5 per bushel and that you will buy 5,000 bushels from me once I deliver them in exactly 3 months. Cattle farmer Tex says that he agrees to this $25,000 deal. They sign a contract, and as part of the contract, Tex the cattle farmer agrees to pay a portion of the total cost. This portion is called the margin, even though he will be paying Wilbur the full rest of the $25,000 upon delivery. Wilbur only makes him pay $2,500 for the contract, and then later on, the rest. As a result of this contract, Wilbur, the corn farmer, is safe in case the market price of corn goes down in 3 months, because no matter what, he will be getting the rest of that $25,000 when he delivers the bushels. The cattle farmer also feels safe because if the price of corn goes up, he is safe to still get the exact price he agreed to at the beginning. So even if the price of corn goes way up in 3 months, he doesn't have to worry about it. This exact transaction is the basis for all futures. This exact setup has been in place for thousands of years and in many continents. First records of it are in Mesopotamia, 2000 BC, and the first standardized and formal version of it came about in Japan in the rice industry hundreds of years ago. Early on, speculators who wanted to make money on predictions of these movements entered the scene. Joe sees Tex and Wilbur make this deal. Let's say he sees that the price of corn went way up, but Tex got this awesome deal and got the corn for a much lower price. He starts to think that he could get in on this price difference and make some profit. So Joe thinks that the weather over the next 3 months is going to be terrible and that the crops of corn won't produce as many bushels and the price per bushel will go up. So he heads over to Wilbur, the corn farmer, and buys a contract from Wilbur to purchase 5,000 bushels for $5 each in 3 months. Keep in mind, Joe has no use for this corn. He is not a cattle farmer. 2 months later, it appears that Joe was right. Corn is now $7 a bushel. So he goes to Wilbur and he buys the 5,000 bushels for $25,000, $5 each, and then goes to a cattle farmer and sells the 5,000 bushels for $35,000 at $7 per bushel. Joe makes $10,000. This little example is the full basic description of the futures market. Nowadays, Joe can sell that contract that he paid $2,500 deposit for a higher price and not have to worry about going and buying corn and then reselling it to someone else. He can play hot potato with it instead. Buy it, price of corn goes up, sell it for a higher price. Now, the concept of futures has been extended to include other things, and this is where it gets abstract. In summary, futures are contracts that promise future delivery and future payment for a specified price, for a specified quantity. The price difference between the agreed upon price and the final market price is used by speculators and investors to make money off the difference.